they're grappling with the same kind of things that the US is, are they not? And, the point being that employment remains strong. They can see a little drop-off in ads and vacancies, but not materially huge. What do they do? Is it, as Phil Lowe was just saying last week, that perhaps after, in this current environment we live in, that the lags now for monetary policy to work are just much, much longer? Or is it deeper than that?
Well, I think Australia is in a little bit of a different situation to the US. Wages growth in Australia is much lower. We've only just started to see wages growth running above 3% annual pace, whereas in the US, wages growth is running at 6% on some measures. So Australia doesn't have the same issues as the US in that inflation story, and we think inflation will come down quite significantly next year, not to the RBA's 2 to 3% target band, but well below its current level of over 7% on a headline basis. So I don't think that there is a need in Australia.
Diana, give me a sense of how base effects play into this as well and how they've been accounted for.
Well, of course, base effects are important for the inflation story because we have to take into account all the monthly change in the CPI. But even if we look at all the broad pressures on inflation, goods prices are coming down. In Australia, we've had impacts from the floods that are increasing fresh food, meat, vegetable prices. All of those things have now turned around. All those COVID supply chain issues globally have improved significantly. Transport costs are back down to their pre-COVID levels. Commodity prices are well down on their peaks earlier this year. Rental growth is still contributing to inflation, but all the housing indicators are pointing down. So I think rental prices will start to peak off in the next few months, and that's at least what some of the leading rental price indices are telling us. So the story is really around wages growth. How high will wages growth become? Will we see some wage price spiral emerging in Australia? I think the answer is no. So I think the RBA can be comfortable knowing that they've done quite a lot in a very short space of time.
Still, the RBA is not done. Some say another 25 in February and another 25 by October next year. What are you anticipating? What does it need to do?
Well, we were actually expecting that today's rate hike would be the last for this cycle, but I just read the statement and they did make a comment, that same comment that they've made in recent statements, that we look to increase interest rates further over the period ahead. I was actually anticipating them to soften that commentary, to potentially say that they could take a pause in early next year. So maybe we could see another 1 or 2 interest rate hikes in early 2023, but I find it really difficult to see Australia managing a cash rate above 3.5% because of the impact to households on those interest payments. Australian households hold a very large level of debt, about 190% of our income. And we are much more sensitive to interest rate changes because of the way our housing market works with variable interest rates or very short-term fixed rates. So Australian households are much more leveraged and we're much more sensitive to interest rate changes. So I think it will be difficult for the RBA to raise rates above 3.5% from here, unless it wants to generate a recession to get inflation down. I just don't think that's necessary.
Given the high level of debt, as you mentioned, and given expectations of further rate increases, might that put a dampener on the RBA's growth projection of 1.5% next year?
I think with their forecasts, assuming that the cash rate moves in line with market expectations, which means a cash rate above 3.5%, I would say 1.5% growth looks optimistic. We at AMP have growth running at about 1.5% by the end of next year, but that's on the assumption that the cash rate pretty much stops at its current level and potentially even goes down in the second half of next year. So if the RBA keeps hiking rates, then we're going to see sub 1% growth here in Australia, most likely.
Diana, I want to get a sense of, I think you guys are anticipating a fall of house prices between 15 and 20% top to bottom in the September quarter next year. Now, the point being that is that something that the RBA would be happy with, given that it is the wealth effect, which it does support a lot of spending there in Australia, and that could take the sheen off growth even further?
I think the RBA's forecast for home prices would probably be quite similar to ours. They've published some of their home price forecasts and models before, And I think that the current environment would be in line with their own forecast of 15 to 20% decline. Look, that will have a big negative impact to household wealth, as you said. But on the one hand, the RBA probably wants to see some weakening in the housing market. One, to take some exuberance out of the housing market, which was a big driver of high prices here in Australia for the past 2 years. Two, it wants to see lower, riskier lending, so lending to high debt-to-income households or households that are generally considered a riskier investment, maybe some investors as well. So there's a sweet spot here. The RBA wants to see some downward pressure on consumer spending, but not too much where you would want to generate a serious growth downturn.